So there were no surprises on my end. Clearly, you look at the 10-year rate today, and maybe the bond market was expecting something a little bit less dovish, and obviously rates moved as a result of how dovish the comments were. But this is a Fed that's been very transparent, telling us that they expect to keep interest rates low for the foreseeable future. They are not ready to taper asset purchases yet, and they do believe that inflationary pressures are transitory. I mean, the reality is if the vaccines continue to go as they seem to be going, if we can prevent another wave, there's a lot of demand set to hit to the economy, and short-term inflation could be in store as a result of that. The Fed wants to see through that, and they do believe that the long-term structural forces haven't changed. We're a far ways away from full employment, so they expect to keep policy easy for the foreseeable future.
Well, let's talk about the present for a second. The 10-year yield above 1.7. That has a lot of people on Wall Street nervous, I'm sure. What signals are you getting from the bond market, and how do you think they're being received by the regular markets?
So the bond market is telling us that this recovery trade and this reflation trade that we all expected coming into the year is now actually happening. And in many ways, that's a good sign, right? I mean, it's a much better environment than when interest rates were at 50 basis points in August. We were sitting here in August saying, God, we hope we can see inflationary expectations moving higher. We hope we can see the real economy picking up momentum. So rates moving back to where they were, closer to where they were at the beginning of 2020, isn't unexpected. It's a bond market telling us that this recovery for trade, this reflation trade, is happening as economic activity picks up.
All right, let's talk about that reflation trade. This morning, we're seeing the NASDAQ definitely take a hit. We were just showing some of the hardest hit stocks on the NASDAQ. Where should people put their money as we continue to see this interest rate environment?
Well, for more tactical investors, over the next months, we would continue to favor that recovery trade. So what does that mean? That means the more cyclical parts of the economy. It means the more value-oriented parts of the economy. It means the more smaller and mid-cap parts of the market. It probably means some pressure on the dollar and emerging markets performing well. I mean, that's what you would expect in the recovery trade. The question that investors need to ask themselves is the word trade the operable word there? Because, in order to continue to think that the deeper value parts of the market are going to continue to be winners, you'd have to believe that the U.S. economy is moving to a new, higher, sustained level of growth. The way I'm viewing this is more of a reversion back. That's what reflation is, a reversion back to where we otherwise would have been. Where do you go from there? I believe we're still going to find ourselves back in a pretty modest growth environment once all this fiscal support starts to moderate in 2022 and 2023, once all the pent-up demand finds its way into the economy. So if you find yourself back in a modest growth environment, then investors are going to be right back favoring those structural growth businesses. So this is a point in time where they're under some pressure. Value stocks rise to the fore because we're in the recovery phase of this cycle.
Shepard Smith here. Thanks for watching CNBC on YouTube.